This episode is brought to you by Verizon. With Verizon, you can now get a private 5G network, so you can do more than connect your business. You can make it even smarter. Now ports can know where every piece of cargo is and where it's going. Robots can predict breakdowns and order their own replacement parts. And retailers can get ahead of the fashion trend of the day with a new line tomorrow. With a Verizon private 5G network, you can get more agility and security, giving you more control of your business. We call this enterprise intelligence. From the network America relies on, Verizon. 5G ultra wideband available in select areas. Pre-qualification required for private 5G network. Terms apply.
This is Optimal Finance Daily, episode 2296. What is a hedge fund and should you invest in one? By Copple with IWillTeachYouToBeRich.com. And I'm your host and personal finance enthusiast, Diana Merriam. Welcome back to Optimal Finance Daily, the show where I read to you from some of the best money and personal finance blogs on the web every single day of the week. So with that, let's hear today's post and start optimizing your life. What's a hedge fund and should you invest in one? By Copple with IWillTeachYouToBeRich.com. If you're looking for a new investment account or you're brand new to turning your money into more money, a hedge fund is no doubt an option you've come across. But what is a hedge fund, you ask? Can anyone invest in one, or is it just for the big shots on Wall Street? We'll clear up all your questions today and look at the difference between hedge funds and other types of investments. What is a hedge fund? A hedge fund is a type of pooled fund that uses a range of strategies to generate active returns for investors. They're usually way more expensive when compared to other types of investment funds, and they're usually only open to high net worth investors. That's why when you hear the words hedge fund, you get a very clear picture in your mind of a guy in an expensive suit with a briefcase. How do hedge funds work? The way hedge funds are designed is to take advantage of identifiable market opportunities. But what does that actually mean? It can mean many things. Hedge funds work by using a whole host of different investment strategies. Hedge fund managers closely watch market data so they can jump on investment opportunities when they arise. Those managers pick the best places to put your money, typically swaying towards riskier but higher return options. Who can invest in hedge funds? Hedge funds are a special type of investment method that has certain criteria before you can invest in one. Hedge funds will look at a range of criteria from current wealth, assets, ability to absorb any significant losses, tax status, and much more. Why so exclusive? It's not just a secret club. Hedge funds have a much higher level of risk associated with them. As a result, the U.S. Securities and Exchange Commission, the SEC, places some strict regulations on who can invest in them. Criteria for investors. To invest in a hedge fund as an individual investor, you'll need to be accredited. This typically means you'll need to have a net worth of at least $1 million. That's not including the value of your primary residence. Or you must have an annual income over $200,000 or $300,000 if you're married. The other type of investor in hedge funds is called an institutional investor. These are professional bodies that invest on behalf of pension funds, government workers, and unions. They typically invest large amounts of cash at once and may be subject to slightly less scrutiny because they're seen as less risky professional investors. Pros and cons of hedge funds. Pros. Number 1, higher returns, potentially. One of the main aspects that sets a hedge fund apart from other investment types is the aggressive investment strategy. Hedge funds don't mess around. They go hard for the highest returns possible. Number 2, flexibility. Another advantage of a hedge fund is that it offers a bit more flexibility than mutual funds. As investments in hedge funds are not traded publicly and have no real body regulating their performance, a hedge fund manager can use a range of strategies, including derivatives, leverage, and short selling. And number 3, diversity. A hedge fund can invest in pretty much anything, whether it's real estate, land, stocks, currencies, or derivatives. When compared to other types of investments like mutual funds, you're usually limited to just stocks or bonds. So if you're looking for a bit more diversity in your portfolio, a hedge fund might be for you. Disadvantages of hedge funds. Number 1, fees. A major disadvantage for hedge funds is that they usually have high fees attached. Most will use a fee structure called 2 and 20, which we'll explain. Number 2, more risk. Hedge funds use a more aggressive investment strategy. This means high risk and hopefully high return. But the number one thing to know about any type of investment is that nothing is guaranteed. Those high returns can just as easily become high losses, the kind that makes your eyes water. And number 3, money is often locked away. Many hedge funds require investors to essentially lock away their money for years to get the maximum return on investment. This may not be an issue for those who are used to keeping their money in the market long term, but it does mean a bit less flexibility to sell whenever you want. They're not for the short-term investor. How much are hedge fund fees? The standard type of hedge fund fee is called the 2 and 20 fee. The 2 and 20 fee structure works by charging both an expense ratio and a performance fee instead of only an expense ratio. It gets its name from charging a 2% asset management fee and then a 20% cut of any gains on top of that. Hedge funds versus mutual funds. Hedge funds are investment pools, so are mutual funds. But what's the difference? The main difference is availability to the average investor. Mutual funds are regulated investment products that are offered to the public and are available for daily trading. This makes them the more popular and accessible option. Hedge funds, on the other hand, are private investments that only accredited investors can use. They're far more exclusive. Another thing that sets them apart is that hedge funds are well known for using high-risk investment strategies to achieve the highest returns possible for investors. Mutual funds are a bit tamer in comparison. Should I invest in hedge funds? If you have an appetite for high risk, $1 million in the bank, and a financial safety blanket to cushion you from significant loss, then by all means go for it. However, with the eligibility criteria being so far out of reach for the vast majority of people, it's probably not a viable option. Even if you are eligible, we wouldn't recommend diving into hedge funds if you're a beginning investor. It's best to start smaller with something like a mutual fund or an index fund. We'd pick the latter. Why choose an index fund? Index funds are very tame in comparison to the glamorous world of hedge funds, but they're also a great steady way to get into investing. Not everything has to be blackjack-style betting on the top companies in the world. Index funds instead invest in a pool of different companies and stocks such as the S&P 500 or the Dow Jones Index. Index funds are Ramit's personal favorite and what he recommends to most people new to investing. You might be surprised to learn that his net worth isn't tied up in super secret hedge funds. It's mostly index funds instead. Index funds are far less volatile. Maybe you won't get those jaw-dropping returns, but you probably won't get those cry and despair losses either. Although we can't promise anything when it comes to investing. Another great thing about them is that they don't have loading fees when you buy or sell a fund, so they're also a more cost-effective way to invest. Hedge funds are a big, scary concept for many investors, and judging by the level of risk, that fear is not entirely misplaced. They may be the top choice for high net worth or highly experienced investors, but for the vast majority of people, index funds are the way to go. You just listened to the post titled, "What is a hedge fund and should you invest in one?" by Copple with IWillTeachYouToBeRich.com.
Support for this podcast comes from Delmarva Power. Now you can make saving money part of your business with Delmarva Power's Energy Savings for Business program. Designed to fit every type of business, the program offers financial incentives that can cover up to 50% of the cost to upgrade to energy-efficient lighting, HVAC, and more. By using more efficient equipment, your business will save money every month on your electric bill for years to come. Learn more at delmarva.com/power savings.
If you've recently bought anything, you've noticed that prices have gone up on almost everything. But thanks to our new sponsor, GoodRx, you can save on something particularly important, your prescription medications. GoodRx is the fast and free way to save up to 80% on the price of your prescriptions. All you need to do is search for your medication on the GoodRx website or app and show your discount at the pharmacy counter. It's that easy. Not to mention GoodRx is accepted at all major pharmacies. And even if you have health insurance, GoodRx may still beat your copay price. You know how much frugality means to me, how many ways I try to save, but never before have I seen a way to save on prescriptions. I really love GoodRx. It's extremely easy even for older friends or family that I've recommended it to. So for simple, smart savings on your prescriptions, check out GoodRx. Go to goodrx.com/OFD. That's goodrx.com/OFD. goodrx.com/OFD. Hedge funds might seem sexy, but even if I was an accredited investor, I still wouldn't invest in them. And while it may sound like I'm saying I don't want to get into the exclusive country club that won't let me in anyway as a way to make myself feel better, that's far from the truth. The main reason why I don't want to invest in hedge funds is because they underperform index funds. 20 years ago, hedge funds were known to generate substantially larger returns than portfolios of stocks and bonds. That's why there's this perception that while they're higher risk, they also have the potential for higher returns. But that trend flipped with the Great Recession. In the paper Hedge Fund Performance, End of an Era, published by the CFA Institute in the Financial Analyst Journal, researchers found that hedge funds typically fell short of the return of an equally weighted portfolio consisting of the S&P 500 and a total bond market index fund over the period 2008 to 2016. The paper cites the reason for this is heightened regulatory oversight and central bank intervention. The financial crisis of 2008 resulted in increased regulation, which means higher compliance costs. And increased regulation decreases various measures of misreporting, which can result in lower observed performance. Further, central banks around the world have stepped up intervention measures in the wake of the financial crisis and continue to do so to this day, with more frequent and larger stimulus actions. The result is decreases in volatility and increased correlations in many asset markets, which makes some trading strategies employed by hedge fund managers more difficult to execute. Bottom line, the exclusive country club is serving bad Chilean sea bass, and you don't want to eat that. That'll do it for this episode. Thank you for being here. Have a happy rest of your day, and I'll be back with you again tomorrow, where your optimal life awaits.